Hey, this is Sasha, and welcome to another episode of Let's Talk Stocks, episode number 184. Now, today we'll cover a handful of economic news, just a couple of things, because not a lot of things have changed since previous week. But I also want to share with you some insight on some history of what potentially could happen to the market if we don't go higher, if we don't go lower. Well, what is it that's possible in the marketplace? So that's what I'll talk a little bit about today, is a little bit of history. And of course, towards the end, we'll just cover a few popular stocks. Now, if you're interested in getting my critical chart services, then take a look at tradersfly.com, where we go in detail with more stocks and more insights for detailed analysis. So with that being said, let's take a look at a couple of different things here. One of the things that caught my eyes here, just recent news, was the U.S. birth rates are at 30-year low despite economic growth. So typically, when you have booming economic growth, low unemployment, higher wage growth, well, we're kind of not getting there with the wage growth yet, but low unemployment is there. But, you have the birth rate that's at 30 years low. Basically, when you have a booming economy, typically you would see more people becoming parents and just, babies continuing to boom, just like in the baby boomer time frame. So when you look at this, it kind of makes me wonder, where is the long-term trend going? Where is it heading? How are these things going to affect economies in the future? Now, there's a lot of other things to birth rates. It's not just economic conditions, right? It's not a one-to-one ever. Of course, there's just due to people waiting a lot longer, looking to secure their jobs, just society in general, the way that it works. But it's just something interesting that caught my eye. In either case, take a look at one of the other things that kind of little talk here in the marketplace was this: North Korea doesn't want to give up its nukes for economic trade. So you can see what the U.S. is trying to do. It's trying to do some kind of deal, but take the nukes. Now, in all honesty, why would anyone give up what they have, these nuclear power, nuclear weapons, if that's their way of feeling secure? I mean, the U.S. isn't planning to give up its nukes. So I don't see why, North Korea would do the same, because if that's their main line of defense or protection, kind of seems a little bit harsh for them to give that up. In essence, then we should be giving them, let's say, 10 times more vehicles and exports and all these other material things. That goes along with any country, really. I mean, if you give, you're going to have to get, and get to give. So it's you have to create a win-win relationship with anything that you do. You can't just expect people to give those things up. Also, one thing that caught my eye was that Germany's first quarter economic growth slowed down. So if you look at some of the numbers here, their annualized growth rate slowed to 1.2 from a 2.5 in the fourth quarter of last year. So, Germany is one of the bigger EU countries out there, and it's something to pay attention to. They run that DAX. So there's a lot of economic things that flow through Germany. And, if that starts to slow, then what if, with Brexit here, that starts to slow, in Europe all of a sudden starts to slow. That could cause a little bit of a problem because, again, we're a global economy, to other nations and to the U.S. as well. So something to pay attention to. One quarter is not a big issue, but if that continues, and that starts to become the trend, that could, in fact, take things a little bit further. In addition, the U.S. Treasuries, again, are spiking above 3. And when you start looking at just overall the number, I haven't done any statistical studies on this yet, which I normally like the numbers for. But if I recall, because these move so slow, you can always go back, even if you're a year late to look at the statistics, it's perfectly okay. But if you go back through, let's say, post-war era, the average, looking at the numbers, and if you do that analysis, I believe is around 4%, 4.5%, if you're looking at these bond rates. And one of the things with that is that just means we can go a little bit higher. So 3%, we did have a little bit of a pop there the other day, and that's kind of what panicked the market a little bit. Plus, you were a little extended here. But if you do go a little bit higher at 4%, that's going to be normal. So that means the economy should slow down slightly, especially as you start getting into 4% and sometimes in the 5% range. So 3% is not a big deal when you look at the, let's say, 100-year time frame. But as you look at the shorter term, because we've had all this stimulus from the Federal Reserve, really it did pop quite a bit, and consumers are going to be paying more. Just like we've talked about Amazon raising its rates by about 20%, right? Going from $99 a month on their Amazon Prime to $119. Looking at Chipotle raising their rates, McDonald's raising their rates, and now you have this oil prices also raising their rates. So basically, take it from the consumer, depending on what you're buying, depending on what you're spending your money on. And you could say, hey, I take other means of transportation. I ride my bike to work. You're still overall going to be paying more for things just because the cost of goods are increasing. I would say on average, it's not just 2 to 3% inflation. We've talked about this over the last 2 to 3 episodes. It's probably more along the lines of 7 to 20% inflation. It's not quite hyperinflation like Venezuela, but I'd say at least 5 to 7, 8% is where things are at as far as inflation goes, with oil prices, with going out to eat, with buying your produce. You're hitting it in all sorts of ways. And I would say the regular person has probably about 5 to 7%. I'm just throwing a number out there. That's my guess. Less in their pocket when it comes to freedom spending on things that you really enjoy or want to spend things on, or even put that extra money aside for savings and retirement. It's just now you need to spend more money to just live. The cost of living has risen. Okay. Now, the thing that I want to look at really is what investors have to look forward to. No recession, but limited growth. And what could this be? Now, I normally use TC2000 by Warden. By the way, check the description or on my website, the resources to get a discount code for this. But it's difficult to go back with a TC2000 just because the way they adjust things and how far it goes back. The better approach actually I like is TradingView for this. And what we'll do is we'll go ahead and take a look here at TradingView here. I have to use Internet Explorer today. My other browser is a little bit slow. So with that being said, as we look at the overall picture of what I want to show you is, what could this mean? Well, if you look at the time frame of, let's say, here's our 1999, okay? The growth here, the tech rise. This is what we really remember as far as traders go, unless you've really been trading for a long time. So really right here from the 1990s, right there, we've had a pretty big boom. We had that pullback with the tech pullback, and then again, major growth, huge stimulus, and then that pullback, the major pullback from the housing crisis. So there we go again. And again, huge incline, huge stimulus, huge rise. So again, I would expect a pullback sometime soon. But if we don't get that, what is it that could happen? Well, if we start taking a look back at history and we slowly go, now we're going back to, think 1999, 2001, going back to the future, okay? Again, we had a huge growth. Here's that tech growth right there. You could see 1988, Windows was coming out, all the good stuff, 1985, 84, 86, all this good stuff was ramping up. So again, let's look and you can see the skyrocket growth right there that happened. Okay, let's go back to the 80s, all the cool dancing that happened, 87 right here. Let's get into this time frame. So again, you can see, again, huge ramp up. And here was our big 1987 kind of crash, flash crash, huge stimulus. Then SEC came out and a bunch of other agencies. I wasn't trading at the time. I was very small at that time. And right here, this growth picked up again and recovered very quickly. But here was your 1987 crash. Okay, so even then, we had pretty big rise. Now, what I want you to pay attention to is here, this next segment that we're getting into. So as you take a look at this next time frame, this is really what I wanted to share with you. And if we go and look at this right here from 1982, the beginning of the 80s, to about 1961, 62. So they call it the 60s to the 80s, okay? 60, 70, 80. So that's about 20 years. Look at the sideways movement that we've had right here, okay? And this is very important, which I'm going to talk about in a second, because right before that, we had kind of the Industrial Revolution, a lot of hype, and you can see here from the 40s, post-war era, huge movement, little pullbacks, of course, but overall, you had massive growth. Kind of like our current stock market, right? Huge ramp up, moving very well, and just powers higher. Now, after this movement, look at what happened here. These next 20 years, and this was a long time frame, right? 20 years is a pretty long time frame. So think about if you were born in the 40s, you get into the 60s, because you're probably 30 years old at that time, and now you just had stagnant economic growth. So by the time you're 50, right here, okay, so call it, this is your 50 years old time frame, that's when the breakout started to happen. But basically, if you were 30 here, okay, because that's when you started to invest, because that's when maybe you accumulated some money, and you were born a little bit earlier. So let's say in the 50s, you were 10, 60s, right here, you were about 20. So coming in, you're right around your 30s, and you go from about mid-60s, 65, to about 82, 83, you basically had 20 years, the majority of your life there, in your core earning years, stock market just moving sideways. So look at this and how this could happen, and the potential for what we could have right now in our economy as well. And this is really what I want to point out to you, is that be aware that sometimes this can happen. Now, I wasn't alive during this time frame, but if you study history here and you start looking at it, wow, and you start evaluating 20 years of basically no major economic growth. Now, does that mean you can't make money on it? No, it doesn't, because of course, if you knew and understand here what was happening, and you were buying low and churning your trades, meaning, you know, more active with your trades, you could have still profited fairly well. Most people don't do that as far as longer term investing goes. Most people kind of buy, sit, and hold. It could be 5, 6 years, but you could see things just move sideways. So if you put in, let's say, call it $100,000 over here, back then that was maybe $300,000-400,000 when you consider inflation, maybe $700,000. So when you look at, let's say, 1964, and you finally kind of got out of this rut around the 80s, right? So again, if you got out at 83, so 64, or call it even 63 to 64, the price difference here is very minimal, and you basically made almost nothing on your money, especially with all the turbulence that you had. I mean, of course, unless you got dividends and those kinds of things, but even then, your money was basically just breaking even, and that's your core, your 30s to your 50s if you were born a little bit earlier. So anyway, so what I want to share with you here is that understand that you can have a period like this for a very long period of time to where you have no economic growth at all. So even if we stay where we're at and we don't pull back and crash, let's say, to 1400 on the S&P right here, and then get a bounce, which is typically a technical and normal kind of movement, whereas instead you just, let's say we start now going sideways in this range, but we do that and we go from the 1920s to the 1940s, because that's another 20 years. Now, I don't think that'll happen because we're in a much faster pace economy now, but it could happen. So again, you start doing this kind of wiggle motion to sideways. And then, of course, you could ramp up higher due to inflation and all those kinds of things. But it is possible. So imagine if that kind of happened. So that's what I wanted to share with you today, is a little history lesson, is just to go back these charts up and start evaluating the potential of what's possible, what has happened. And the Dow Jones is really the main one, because that's how far you could go back. But of course, companies here rotate. So you could see as we kind of got into the market here, and you had this huge ramp up, kind of tulip fever way up here. That's where you had that major crash, where a lot of people lost their money, coming back all the way to the 40s. And, and that's when things finally started to ramp up. So do some studies, do some lessons on this, and go back, and it'll give you a perspective. So let's take a look now at a few charts Here we're in the S&P. I think we're acting a bit weak. If we look at the S&P, I talked about this for some of my members, that when you look at the SPY, the volume is struggling. We're really, the sell-off volume is picking up much more so. And that's what I would be concerned about, is that when you have this ramp up in growth so short with like 6 days green, 8 days green, when you start seeing those headlines, that's when you take some profits. And I took some profits here yesterday and today, and I'll be adding back, kind of buying the dip as we pull back further. So if we get back kind of in that 2600 level, call it right here, 2600, again, I'll buy up some more shares and those kinds of things. But for now, for the time being, you know, I'm seeing some things pulling back. It's overdue. Again, if you look at things here and just look at the Bollinger Band, you're kind of up here at this stretch level. You could come back right here to this 2600, and things again will retest those levels and would still be healthy as long as we get that bounce. You know, so that's one thing to kind of watch. If you start looking at, let's see here. Let's go into some stocks. Actually, let's go back. I'll keep it on the Bollinger Bands for you for now, so you could see. If we look at kind of Amazon here, okay, also a little bit stretched, as you could see right there near the upper range of the Bollinger Bands on the weekly. If you look at the daily, we're kind of in the middle, but overall right there you could see 1600 seems to be a problem area. So when we got into that, we're acting weak. Strong companies break out, right? So they don't just kind of hang out, you know, but you could see what happened was that, boom, we sold off, bearish volume picked up there pretty quickly, and it created some problems. Let's check out CMG here, also trying to make its way a little bit higher here. We had this digestion period. You can see popped a little higher, got into 450, struggling again a little bit. You know, this stock's been hammered down quite a bit, so you can see this descending trend line. Google also, one that's trying to hold that $1,000 level, but you can see it's kind of creating these lower highs. So again, I'm seeing just a little bit of weakness there, not anything huge, but you know, something to just kind of be aware of. Facebook also, the run up, a little too far, too fast. Again, too quick, just like last time. This was a little fast. So you had a pullback, so again, a little bit quick. The angle is steeper. So again, if we pull back to the 170, that would be, again, more healthy. Let's take a look at here. MasterCard was kind of getting into that 190 level, but you could see all these stocks, they're again getting that euphoria, the stimulus kind of feeling. So again, are creating a little rounding top and could create a few little problems here. If we look at Netflix, one of the popular ones, huge growth here at the 335 is where you have some resistance, 330, 335, and we're kind of creating also this upward trending support line that could be right here coming out, boom, either break out or break down. And right now, looking the way stocks are, I think it'll break lower before it breaks higher, but time will tell. Eventually it'll break higher just due to natural tendency of the market. PayPal staying between $70 and $80 range. Again, also if you look at a little bit of a descending trend line right there, also acting a bit weak. So you could say this is a triangle pattern there as well. Again, could we just isolate here for a bit and break out higher? Absolutely. But just understand things are acting a little bit weak, and the bearish volume here is picking up as well. If we look at Shopify here, also struggling, 150, and here's kind of your support level. So kind of in that range between 115 and 150 in there, and Tesla still struggling to get back above that 300. So those are a few of the common stocks that, you know, I want you to take a look at and evaluate for yourself at how they're doing, what's going on. One thing is IWM, and here's the small caps really, are trying to run. It's trying to break that 160. You can see right there on the IWM or the Russell. But, you know, it pulls back. After that one-day break, you got this pullback effect today. So when you look at this S&P, we're already down 10, probably 13 points right now. I'm not looking at the live movement here. Let's take a look here. If we see here the S&P on the daily, and we see here lows, highs. Okay, so we're kind of isolating. So about, yeah, 10, 11 points here for now. We'll see if that continues to just hold here at the 2,700 or breaks lower towards the end of the day. We'll see. Friday, usually things get a little weak because people don't like to hold things throughout the weekend, especially day traders or shorter term swing traders. They'll get out of positions, especially if they've had some profits. They might take some off. So be careful here as you get into Friday as well. So those are some things to watch out for. Again, check out some of these things. Read up a little more on Germany, how it's doing, these bond rates. Take a look at, oil and all this inflation that's going on. This is really what's happening in the marketplace. And take a look at that history. Study a little bit from historic chart patterns and prices of what has happened in the past. Now, we're in a whole different time frame. Yes, it is different, but human psychology operates in a similar way, and it's slow. It's slow movement. Things move slow, just like the Federal Reserve. So all these things, do you think we may not have a 20-year sideways market? It's possible. You never know. So, of course, normally we like pullbacks and then bounces from there. But it is possible that you might get a 20, 30, it could be a 40-year sideways market. You just never really know. So study some history, take a look at things. The market hasn't been around forever in the sense of the stock market, and the modern market is much different with all the computer trading, algorithmic trading. But overall, people have been doing trades, 3 oxes for 2 hammers, or 2 chickens for 2 bulls or cows. They've been trading for a long time. It's just, it hasn't been at this caliber with these kinds of companies and this type of situation. So as far as economic growth goes, inflation of prices and movements of investing in these companies so that you could build your wealth and assets for the future, this kind of movement, you have to be prepared that could we go down? Yes. Could you go up? Yes. Could you go sideways? Absolutely. So all these scenarios are possible, and what's important is that you find a system, a strategy, an investment plan that kind of works for you, because nobody can just tell you what to trade because their risk tolerance is going to be different from yours. Anyways, thank you so much for joining me. Don't forget to subscribe on YouTube if you want to get the notifications as I release new videos. Just click my face right over here, or get on the newsletter list right up here. Click that link right there, enter your name, email address, and once you're on the newsletter list, you'll get announcements. We have some new announcements coming up in the next month when we'll be releasing the Options Iron Condor course and also the Options Calendar course. They will be released very soon, probably within that next 60, 90 days at most. We're just finishing up the study guides, the editing for it, and should be good to go. So anyways, thanks for joining me. In the end, remember, do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.